Hello, everybody, and thank you all for joining us during the Lytham Partners Fall 2024 Investor Conference. My name is Roger Weiss. I'm a vice president here at Lytham. Today, we welcome back two very experienced and very thoughtful folks whose jobs are to sift through the economic and trading markets and make sense of the world's current investing environment. By way of introduction, we have Ryan Detrick, Chief Marketing Strategist, the Carson Group. Ryan is a recognized authority on the financial sector and is a chartered market technician, known for his keen insights and ability to analyze market trends. As Chief Market Strategist for the Carson Group, he contributes a deep understanding of investment strategies and macroeconomic dynamics. Ryan regularly shares his insights on various national broadcast outlets such as Yahoo Finance, CNBC, Fox Business, Bloomberg TV, and radio. Also joining us is Art Hogan, Managing Director and Chief Market Strategist, B. Riley Wealth. Art is a highly regarded expert with a proven track record of providing astute market analysis and strategic guidance. A frequent guest in live interviews on CNBC, Fox Business, and Bloomberg TV, Art's insightful commentary and straightforward manner have made him a respected and well-known figure in the financial media for many years. Last year at this time, there were a host of economic issues and headwinds, but I think the markets were generally optimistic. The S&P 500 was around 4,337, but the Fed was holding firm in the face of stubborn inflation. Now the S&P is up almost, I think, 34%. The Fed recently cut rates by half a point, and many stocks are performing without having an AI or GLP-1 theme. But there's an election coming up that looks like a toss-up. The Middle East is potentially lurching to an all-out conflict. Consumer confidence is down, and demand slowing. China's economy is questionable, and we don't know if we'll have a soft or a hard landing. So, gentlemen, I'm going to throw it out to you. Is the glass half empty, half full, or should we be hiding under a portfolio of treasuries?
Thanks, Roger. That was a great introduction. And also thanks for highlighting the fact that it felt like last year you were a bit surprised by how optimistic both Ryan and I were, and a sea of pessimism. So last year was the year, I would characterize last year as the year of everyone, at least in the first half of the year, calling for a recession. And that was the waiting for Godot recession that never showed up, and for a lot of good reasons. And both Ryan and I were in agreement that we're just getting our signals wrong. And you can get bad signaling from things like inverted yield curves and leading economic indicators. And certainly when you start to use signals that worked, sometime in history and apply that to a post-pandemic world, it's very difficult to get that right. So I think we've now worked our way into 2024. And what's interesting is we started this year with most people thinking the Fed was going to cut about 5 times, and they're going to start in March, and markets would follow suit. But a funny thing happened on the way to the Coliseum is the inflation stalled a little bit in the first quarter of the year, and the economy continued to chug along very nicely. So if you look at the GDP growth rates that we've seen in the back half of last year and the first half of this year and what's estimated for the third quarter, the economy is doing pretty well. I think the only thing that's really changed in my view and what drove the Fed to cut rates at their last meeting was they wish they'd cut rates at the meeting before that. Jay Powell even said in a commentary that had we had the jobs report at the July meeting, we would have cut rates then. So I think their 50 basis point cut was really a makeup for July, and we'll probably continue on this cadence of 25 basis points for the rest of this year. And I think that signals to investors and to the economy that things are likely going to get better, not worse. And I think that that's going to be a tailwind for equities. It's been a headwind, especially in some of the more cyclical sectors, and certainly especially in some of the mid-cap and small-cap stocks.
So thanks for having me back. Yeah, this was fun. A year ago, like Art said, it wasn't very popular to be kind of optimistic, but fortunately here we are. And Art covered a bunch of good bases there. So I'll kind of pick some holes that I want to dig into. Manufacturing in our country is weakening. The economy overall showing some cracks. But listen, we do not think we're heading into a recession. We think it's more of a mid-cycle slowdown. Now with the Fed finally cutting, and we were in the camp, they probably should have cut, at the previous meeting, but like Art said, now they kind of brought the big eraser out. That's going to help small business investment. Two worries of ours, or two concerns, maybe to say. Housing data has clearly been weak. We know that. Well, interest rates as high as they were, that's really a big issue. And small businesses, they really are impacted by higher interest rates. Now that we have more of a dovish Fed, we think those two areas of the economy really could start to work here. Let's talk about earnings for a second. Earnings on the S&P 500 are expected to hit an all-time high 12 months from now. Okay. Forward estimates on S&P 500 earnings right now are about 267. What in the world does that mean? It was 225 at the start of 23 when everyone was promising us a recession. So earnings continue to justify this bull market and this economic cycle of growth. Profit margins continue to expand. So about the consumer just for a minute here. There are cracks in the consumer. Credit card delinquencies and things are going higher. There's no question about it. But in a lot of ways, Roger, we're more normalizing levels we were pre-pandemic. I think that's really important to note. Yes, there's a lot of debt out there. There's also a lot of net wealth. There's also a lot of equity. I call this denominator blindness. If you look at like credit card debt as a percent of disposable income, it's like 5.5%. Well, you know what? It was 8% before the GFC, and it was right about these levels pre-pandemic. So yeah, there's more credit card debt, but there's a lot more equity. So those are some big things I think I want to focus on to kick things off. And I know, we'll talk about the Fed for a second here. I'll wrap this up with this. The question was, well, the Fed just cut 50 basis points. They cut 50 basis points in 2001, 2007, and a 100-year pandemic. Not very good times. Do they know something we don't know? We would say no, because again, they probably should have cut the other time, the time before. Our take, again, is these cuts make sense because inflation is last year's problem. Inflation continues to improve. And last comment here, when the Fed cuts interest rates within 2% all-time high, like they just did, people say, can the Fed really cut all-time highs? Yes, they can. I found 20 times they cut within 2% all-time high. A year later, Roger, S&P's higher 20 times. Up 13.9% on average. There's lots of other factors. I would never blindly invest in just one stat, but there is something called don't fight the Fed. With the Fed easing, with an economy that's slowing, not going into a recession, and some other parts of the economy that could be strengthening, like small business investment, CapEx, and housing, we're still pretty optimistic. We're going to avoid a recession, and this bull market is alive and well.
That is phenomenal. I appreciate that view. And I guess I'm going to start, keep on the Fed question mode here. And first question for you, Ryan.
Yep.
How would you grade Chairman Powell on his handling of the economy? And what rate would you be targeting to get us to that Goldilocks economy in 2025?
Yeah, so I think I give him like a B- because honestly, the reason we've avoided a recession, I don't think it's because of Fed policy, because the consumer has just been so strong. Something that's happened that a lot of people didn't expect. When they hiked interest rates, what happened? A lot of wealthy people parked money in money markets. There's still over $6 trillion in money markets. There's a lot of income that we didn't see coming. And let's be honest, in 22, they probably should have started hiking a little bit sooner. Maybe recently they should have started cutting a little sooner. But overall, I'll give him an A+ here, but he did avoid a recession. We just had a 100-year pandemic, shut down the economy, all the supply chains, all that stuff on the other side. And here we are. And I'll tell you what I was impressed with Chairman Powell at the conference when he cut interest rates. He was telling some jokes. He looked very relaxed. He looked like he knew, he'd done a pretty darn good job. And again, this is perfect no, but overall, those are some big positives. Now, where we are, listen, we think there's probably another 50 basis points of cuts coming later this year, maybe another 100 basis points cuts coming next year. Again, when you have a core core PCE, that's the Fed's favorite measure of inflation, running like right around 2% or so the last couple of months, and you take out shelter, which probably a year ago we talked about shelter being the stubborn part of inflation, but lots of other parts of inflation are coming back. We simply just don't need interest rates here. One final comment that kind of put all this together, and I'll turn it over to Art. We are really impressed with the productivity in our country. United States, the last 5 quarters, had productivity running close to 3%. Well, that is way more than about 1.5% we saw for like a decade before. Why do we have more productivity? It's not about AI yet. It's because people are not getting fired, but people are not leaving their jobs either. People are staying where they are. People are really getting better at their jobs. And we've had a big jump in productivity. In the mid-90s, we had strong productivity. We also had an economy that had some higher than expected inflation. I'm sorry, interest rates, but Greenspan said I can cut interest rates. And the worry was if you cut interest rates, inflation would soar. Sound familiar? It's where we are now. But when you have strong productivity like we do now and back in the mid 90s, it puts a cap on inflation. It allows for higher wages and you can get lower interest rates, which again can juice the economy. So to us, the big key to this whole thing is stronger productivity, something we've been calling for a while now. We're seeing it right now, and I think that's still a positive thing out there for the economy and honestly gives the Fed cover to cut a couple times and not worry about inflation coming soaring back.
Thank you. Art, anything you want to add to that?
Yeah, I think Ryan really laid that out nicely. I would concur with the grade. He's maybe a little tougher than me. I'd give him a straight solid B, but where did he fail? I think he failed in using the term transitory for too long. Unfortunately, most of the inflation was transitory, but we thought transitory would be months and quarters, not years, and that's exactly what happened. That's how we got tripped up. And I think the problem with the current makeup or a modern Fed versus the last time we had this kind of inflation, when you have Paul Volcker, is there was no transparency. So you didn't have every Fed speaker utter their every thought that they had about what was going on in the world, where monetary policy was heading, et cetera. So to give you an example, when Paul Volcker would change rates, he would do it on an unscheduled basis frequently and increase by 2 percentage points at a time. And the only way, Roger, that you and I would find out about it was that Manny Hanny and Chemical Bank raised their prime rate the next day, right? And that was it. There was no presser, there was no statement, there was no Fed speak. And during the Great Financial Crisis, a lot of that changed. We introduced a press conference after every meeting, and everyone has to sort of delineate every word that comes out of Chair Powell's mouth. And then we give a microphone to every member of the FOMC, and they get to talk about how they feel about interest rates and what's going on. I think that has been part of the reason that the Fed hasn't been as effective. But I think the point that Ryan made that's the most important to me is that with or without the Fed, inflation was coming down. And the biggest driver for inflation coming down was our increased productivity. So at the end of the day, that increase in productivity has done a lot of the work for the Fed. And, along the way, they just didn't stub their toe too many times. And I think that'll be the case on the way out when they start cutting. I think they're going to do this the right way and let us know what they're doing. The other thing that I thought was crazy about when they cut rates by 50 basis points, there was this uproar of, oh, what do they know, or what's going on, or that's a jumbo size rate cut. Well, to put that in context of where the CME FedWatch tool was for the 2 weeks before their meeting, was the consensus was 50 basis points all the way going in. It was just everyone was surprised by the fact that they actually did what consensus was. It was something like 60-40 or 70-30 every single day. So it wasn't that big a surprise. And I think Ryan's right about the fact that they wish they had done July. And here we are. I think the more important piece of the puzzle for what Jay Powell has done here has not overreact, hasn't been political, and will continue to be data driven. And the data they're really looking at right now, which I think is really important, is it's not the inflation data anymore. We can sort of, to Ryan's point, that's last year's issue. They're going to watch every piece of the puzzle that spells out what the labor market looks like. We went from creating about 170,000 jobs on a 3-month basis in the non-farm payroll numbers to about 116,000. Now, that's well within a window that's comfortable. To keep full employment, we need between 100 and 150,000 jobs on a monthly basis being created. They don't want that to slip outside the window, and I think that's why they finally got off the sideline and said, inflation is heading in our direction, but we want to make sure this normalizing labor market doesn't become a soft labor market. That's where we run into trouble.
Got it. And then I could just follow up with that, because you kind of segued into, how one keeps that balance from a Fed standpoint between employment and inflation. Is a soft landing doable here? And what part of the economy worries you the most?
Yeah, well, I'll tell you, I'll jump on that real quickly. And soft landing is a nebulous term because we just invented it. And to sort of describe something that we just invented, but I think what it really describes is being able to tackle inflation without going into recession, right? And I think a hard landing would be, the mission accomplished on inflation, but you just crushed the economy. And we've had experiences of both to a certain extent, but I think what we've been able to do because of a strong and well-employed consumer is to watch inflation come down as it continues to, without wrecking economic activity. And that economic activity, to Ryan's earlier point, is coming from the service sector more than the manufacturing sector. Is that terrible? No. We're as a U.S. economy, we're much more driven by services than we are by manufacturing. And quite frankly, manufacturing has been in and out of contraction for 18 months. But Services remain strong, although cooling a bit, which is good because they were overheated in the sort of revenge travel timeframe we went through in 2023. I think, to me, a soft landing I would describe as being able to get inflation back in check without crushing the economy, without spiking unemployment and things of that nature. And I certainly think we're still well within earshot of that.
So, I love that discussion about soft landings, because it's true. Like, we've been in the camp, a Carson group, for 18 months because it was a soft landing, hard landing. They're implying landing a plane. We've said, no, the plane has plenty of fuel. I mean, that's the lingo we've used, and we're still in that camp. To me, it's more of a mid-cycle slowdown, which you tend to see. I mentioned, again, the mid-90s. What happened mid-94? The Fed hiked rates a bunch. You had Orange County go under in December 94. The bond market had a terrible year. Stocks didn't do that well. Some of that sound familiar? We just saw a lot of that in 22, then the regional bank crisis that we just had back in March of last year. Then the Fed could cut, and we can continue to expand, and those are some similarities that we're seeing right here and right now. And I love the idea about the soft surveys of manufacturing. Art pointed out, for 18 months, manufacturing been in contraction. We've heard of tons of people on TV, not Art and I, but a lot of other ones talking about the ISM manufacturing sub 45. It's always been a recession. Always been a recession. That's soft data. That's a survey. Yes. That's people that are employed, that are giving their opinion. But look at the hard data. We've been saying this for 2 years now. Look at industrial production. Okay, that's hard data. What's really going out, output that's really happening, manufacturing output that's really happening. It's up 2% the last 12 months. I'm not saying that's great, but I am saying industrial production's it's up a little bit. So it's showing this real difference. And believe me, we pay attention to soft data also, but we're really focusing more on the hard data. And the hard data is saying, yeah, manufacturing is not great, but it's not in this massive recession that we keep hearing about. And just look at the market. I'm probably going to talk more about the market here coming up, but look at the market, what's leading, right? I mean, those cyclical things, your industrials, things like that. Yeah, Boeing's not having a rough year for some other reasons, okay? But some others, the market, the message of the markets that we're paying attention to, we're still seeing a very rather strong economy. One final comment here on September. The start of September was obviously very rough. The start of August was obviously very rough. So we've seen some volatility. Probably see some volatility in October. Full disclosure, I know we're going to talk about that. But what we saw also in September that really got me was the action in high yields, okay? High yield bonds, corporate bonds were very strong the first 2 weeks of September, implying there was no major monster under the bed. All these talks about the recession, all this stuff, none of it was true. I mean, honestly, if you look at data, the high yields and the bond market, credit markets were saying there's no monster under the bed. This is just normal volatility that you tend to see. Most years are going to have 3 to 4, 5 to 10% corrections. It's just how it works. And I think it's really important to remember to follow the hard data, not just get all in on the soft data like so many people did last year and honestly parts of this year.
That's such a good point. Ryan does some great work overall, but one of my favorite things that he puts out is something called, I think it's called Facts versus Feelings.
Yeah.
And Facts versus Feelings really falls into this category of soft versus hard data, right? So I'll give you another example. He talked about the ISM data. My two favorite are the Conference Board, which puts out a consumer confidence, and the University of Michigan, which puts out their own survey of confidence by consumers. Now, what's been good about the University of Michigan survey is the entire cycle has seen inflation expectations very well grounded. That's been useful. The rest of it's been almost the most useless data you can read because, and this is the best juxtaposition, when the University of Michigan comes out, it's always followed by, at least their first report of it is, by retail sales. And wouldn't you rather know what consumers are doing versus what they're saying in a survey? And that has proven to be the thing to look at. Retail sales have been robust. Now, that's not to say the consumer hasn't become more value conscious or more price conscious, and we're certainly seeing that being reflected in the businesses that offer that proposition. But I don't think that's any more different than we were for the last 30 years with the introduction of Amazon and Walmart and our ability to find value. So I just think that the sort of the death of the American consumer, which has been played out in a survey basis, has never come to fruition over the course of all of last year and well into this year.
I'll just put a cherry on top. I know we want to move forward. If you look at the retail sales, like Art just said, there's something called the control group that's inside retail sales. That's what flows to GDP. It takes out volatile things like gas stations and tobacco sales. But long story short, the last 3 months, the control group has on an annualized basis been close to 6% growth. Okay. The consumer, a lot of worries out there, and there are some cracks. I will admit, we can maybe get into that when we talk about worries. But the bottom line, what we see right now is a labor market that's fairly full with consumers that are out there still spending, and that is a positive clearly for the economy going forward.
Very good. Well, let me switch things a little bit. And Ryan, I'm going to ask this question to you again because I asked it to you about a year ago, which is what are the historic market reactions to hotspot eruptions and geopolitical risk? From both the risk and the uncertainty that's going on out there.
Well, I mean, near term, you can get volatility. Let's be very clear. I know I looked at like over, I think, 44 or 45 different major geopolitical events throughout history, at least back to like 1900. I'm talking, major wars, assassination attempts, lots of things. And the honest truth, 6 to 12 months later, you know what tends to happen? Stocks still tend to be higher. Now, some of those events pushed us into a recession. So you can say kind of all bets are off. But if we can avoid recessions, the Middle East, I mean, listen, I'm not minimizing what's happened in the Middle East and obviously Ukraine and Russia and those things that just seemingly see no end in sight. The reality is we've still rallied in the face of those, right? And we've seen these conflicts before. I'm aware of the suffering that's gone on there, but from as a steward of assets, when it comes to investing, what we know again is bad things have happened throughout history. Uncertainty. I always always like when I hear somebody say, I'm going to wait to invest until there's a little more certainty out there. I've read a lot of history. I've been doing this for over 2 decades. I've never seen a time where there was no uncertainty. There's always uncertainty. This time a year ago, we're at a really good run, a rough September, right? Bottomed in October. Stocks still finished up 25%. It felt like people were scared to death the whole time. Here we are now, ballpark another 20% this year, and it feels like there's just a ton of fear. And that's how it works. I'm aware of that, but I think it's really important. History doesn't repeat itself, but often rhymes. Mark Twain, I use that a lot. And getting back to your original question, there are going to be these major geopolitical events. They continue to happen throughout history. But you know what else has happened since May 26th, 1896, when the Dow Jones Industrial Average started trading? Stocks have always come back to a new high. Believe me, sometimes it takes a while. Okay, sometimes it takes a while to get back to a new high. But I think it's really important for investors to remember not to always follow the headlines. You should know what's going on in the world, but to really separate those headlines from your long-term investment goals, because the best time to invest a lot of times is when there's a lot of red on the screen, when there's a lot of fear out there, when things are on sale. Last comment, they say the stock market's the only place things go on sale, but everybody runs out of the store screaming. We continue to see that. It's hard the way our brains are wired. When there's trouble, we're trained to huddle up. We're trained to run back into the cave, to get out of there, get out of trouble, because that's what we were taught throughout, decades and centuries of life. But when it comes to investing, we really need to retrain our minds. And that's why I think it's so important to, I'm so honored to be here talking with Art, talking to all the listeners out there again about some of these things that are important for people to remember during these geopolitical events that'll cause near-term worry and fear. Still, follow your long-term investment plan.
Yeah, so Brian, that's so well stated, and I think that the bow that you put on that entire statement was exactly that, because our brains are wired to what we're afraid of the most is the unknown, and as human beings, that's how we're kind of hardwired because of our evolution. But to the extent that the other piece of the puzzle, Roger, that I think is hard for us as human beings, their emotional piece, is we see terrible things going on in the world. But it's very difficult oftentimes to put an economic cost on that, right? It's hard to model in some atrocious things that we see going on in the world. So, with all of the geopolitical uncertainty, part of us feels terrible about what's going on a humanitarian level. And sometimes that makes us feel like if we feel that strongly about this emotionally, we should probably feel that strongly about it economically, and those never match up. And that's one of the issues, right? We elicit a very strong emotional reaction to anything that's terrible going on, and we've got plenty of that going on in the world right now. But try modeling that out into earnings expectations for the next 12 months, and you just can't. So I think Ryan is right. We keep marching forward. We're always nervous about something. I've been doing this for 3 decades, and there's always been something that we should be concerned about. And yet, the market is significantly higher and continues to grind higher as we get better at discovering things that are making everybody's life better.
Got it. Let me switch again, and maybe move toward more of not only the economic, but now directly to the markets. Clearly, the S&P's move the last 12 months, the market certainly anticipated the Fed's actions. But it always begs the question, how much of the upside has already been factored in to the market? And, how much higher is up? And maybe Art, you start us off.
Sure, and that's always that's my favorite question to get. How much of this good news has been priced in? The market's a forward pricing mechanism. Everyone knew the Fed was going to cut rates. Well, yeah, everyone knew at the beginning of the year the market was going to cut rates, and they didn't. But we shifted gears because the economy was actually still grinding along nicely. Employment was very strong, and while inflation had sort of taken a pause in its downward trajectory, we had the market grind higher. We had a bit of a dip in the April month, and then plowed ahead last year. Then we had another one in September that was very healthy, and we bottomed out very nicely in October. What I would tell you is, if in fact we're going to have something north of mean GDP growth. So let's say 2% is mean GDP growth, and we're running north of that. We certainly are right now. On a 12-month run rate basis, we're closer to 3%. The estimates for the back half of this year look to be between 2.5% and 3%. That's going to drive better earnings, especially in an environment where we look at the earnings cadence for the third quarter, fourth quarter, and in the first half of next year. So the 12-month cadence that Ryan alluded to. The great news about that, not just growing, because it is significantly, and estimates are always a little bit conservative, but it's growing from places where it didn't grow last year, meaning there are now 9 of the 11 sectors that are going to participate in this earnings growth in the S&P 500, whereas in the end of 22 and most of 23, you're really only getting earnings growth from 2 sectors, not surprisingly, technology and communication services. So in effect, what has the market sort of sniffed out in that? Now, if you look at the makeup of the new all-time high, that all-time high is coming from a broader spectrum of sectors in the S&P 500, which I think is a significant positive. And when things start to broaden out, they tend to be more defensible at the levels that they're trading at. And I continue to think that the broadening out is also going to include things like mid caps and small caps. So as opposed to entirely focusing for 12 months or more on 7 artificial intelligence darlings, we're starting to pay attention to 493 other companies that are actually doing some great things. And along the way, remembering that the gap between small caps and large caps hasn't been this wide, going all the way back to 2000. So some mean reversion there likely makes sense, especially if it's in an environment where interest rates are coming down and we have steady economic growth.
So I'll kind of chime in there because great points about earnings. And we heard for the longest time, only 7 stocks, only 7 stocks. I pushed back against that. There were more than 7 stocks going up. But just, right around the end of September, what did we see? We saw new all-time highs on the Dow Jones Industrial Average Advanced Decline Line, NYSE Advanced Decline Line, Mid-Cap Advanced Decline Line, and Small Cap Advanced Decline Line. What's an Advanced Decline Line? It's a cumulative basis, how many stocks go up versus down every single day, and you keep going. Long story short, market breadth leads price. Once we start to see market breadth roll over, and think about the tech bubble, right? Technology was about the only thing going up. A lot of other things weren't. Eventually that broke. In 2007, what happened? Financials. A lot of other areas were breaking down in 2007 under the surface. What are we seeing now? We're seeing broad-based participation. It's not just about technology. It's not just about communication services. Even something like Staples, right? Staples they're up. They're doing fine. But on a relative strength basis, I love to look at what relative strength tells us. Staples are hitting new lows against the S&P 500. Now, the stocks are still up, but just not up as much as everything else. That is music to the ears, I think, for someone who's bullish, because you don't want something like Staples to be outperforming. We can still have volatility. We can have an October surprise. October historically is the worst month of an election year. We've had a heck of a run. We've got some pre-election jitters. I wouldn't be shocked at all. We had another one of those 5 to 8% violent pullbacks sometime this October. That's perfectly normal. But the bottom line was this much market breadth, this much participation that we're seeing. I know we're going to talk about small caps, mid caps, and things like that in a little bit. We're seeing a lot of other groups that are going higher. That to me is the underpinnings of a strong bull market, one that likely is still alive and well, like I've kind of been saying. And it's just a real nice spot where we were a year ago to see a lot of different groups that are participating to the upside here, Roger.
That's great. If I could, take that little, bit of insight from Art on small cap names and kind of ask you guys to expand that a little bit. Clearly, our conference is highlighting a lot of small cap names, and they certainly have not experienced the same love and attention of their larger cap brethren over this last year. How do you think about them now? And specifically, are there any sectors within small cap land that look particularly attractive to you guys?
Yeah, that's a great question. So to the extent that it takes a while, right? We've seen a couple of mini starts of that sort of small cap mean reversion climb. And when did that happen? Well, if you look at the beginning of this year, when we assumed that rates are coming down pretty significantly, small caps actually saw a rotation in. When we shut the door on that being a potential, small caps gave all of that back. Now, obviously, they're going to sort of get in front of that. So if you look at small cap performance over the course of the last 30 days, they've actually outperformed. The Russell 2 has outperformed the S&P 500. I think that's important. And that's where it starts, and it starts to get attention. It's very much like, what have I missed? And investors start to look at what hasn't worked yet. It's like, oh, I've done great at utilities, but what have I missed? And all of a sudden it's like, what's going on with the Russell 2? And as that starts to show some relative strength and then starts to break out a bit, I think that's going to be the tone for that. Now, when you break that down to sectors, you can use the Russell 2 or the S&P 600 small cap. They're both good indexes to watch to track that. But I think intuitively you want to think about, well, here's the what they're doing, but where's the why? And the why really is, who's the most sort of sensitive to interest rates coming down, and looking at those companies that have actually termed out some of their debt or actually on adjustable rate debt structures. And that's where I think you're going to see the largest of the benefits accrued to them. So one of the things I think is the most interesting is that regional banks make up a good slug of the small cap universe and have been since the sort of regional bank debacle and our assumption about all commercial real estate being terrible, been a big anchor to the Russell 2000. And if you sort of back that out, but I think that's the wrong way to think about it in my mind, because I think some of the regional banks are in much better shape necessarily than they project in terms of their multiples. The multiples are so unchallenging right now. And I would offer up, in an interest rate environment that's coming down, all sorts of real estate, whether it's commercial, writ large, or residential real estate, is going to actually start doing a whole lot better. And the reason I say that is, so think about the recency bias that you have when you think about making a financial decision. Start of the year and the first quarter, you can get a 30-year fixed conforming mortgage for the low price of 8.5% or 9% interest, right? In July, it was 7.5%. This morning, it's at 6.15%. Imagine how much activity in existing home sales happens when you start to see a 5 handle and you remember that you saw an 8 handle last year, and you've been thinking about getting out of the house, but you've got that 4% mortgage and you're like, oh, I'm not going to take an 8% mortgage on. 5.25%, 5.5%, 5.75%, I think is going to be a motivator. And that's likely going to happen at the most opportune time, first quarter of next year, as we head into the home selling season. And with that, I think we'll usher in a whole lot of economic activity that hasn't been around for 3 years. I think that's a super healthy thing. And with that, will most likely increase the health of a lot of the sort of underperforming regional banks that kind of sit in there as an anchor on top of the Russell 2.
Yeah, it's great stuff there. I was going to mention regional banks also. Regional banks are up 20% for the month back in July. Now, it kind of chopped around a little bit since then. We saw small caps, not probably too surprisingly, up, or at least Russell 2, up 10% the month of July. That is like one of the largest monthly gains ever. Of course, I'd like to take a look at what happens after that. 1 year later, you're talking up over 20% on average after a blast of strength like that 20% or like that 10% gain we saw in small caps back in July. Now let's think about last year. Rewind for a second. November and December, like Art was saying, we had a lot of optimism the Fed was going to start cutting. The Fed was going to start cutting sooner this year is what I should say. The Russell 2000 was up over 20% the last 2 months last year. That was the third best 2-month rally ever in the history of the Russell 2, which goes back to 1979. I go back to 1978. It's almost as old as I am. But you think about it. So we were kind of sideways the first 6 months of small caps. Frustrating, sure. We've been overweight small caps all year. Our biggest overweight, though, has been mid caps, which is quietly, I think, done even better. But to me, when you're up 20% in 2 months, you go sideways for the first 6 months of the year, I don't know, maybe that's not so shocking. And now that we finally have the Fed cutting, we've looked into this data. It's once the Fed starts cutting, like Lucy in the football with Charlie Brown, pull the football away. Many times small cap investors say, here it comes, and she pulls the football away, we fall back. But now the Fed is officially cutting. We've already talked about the Fed, don't need to say anymore. There are a lot more cuts coming over the next year or so. That is another positive. Also, talk about earnings. Earnings in the S&P 500 next year expected to be about 14-15%. Small cap S&P 600 earnings closer to 20% earnings expected next year. I don't think anybody realizes that. Then you talk about valuations. Okay, some parts of the market are pricey, some are cheap. Small caps relative to large caps right now. Okay, right now, or maybe a month or two ago, they're even a little bit cheaper, but still right now, about as cheap as they've been relative to large caps since 1999. What does that tell us? That kicked off a 12-year period of outperformance of small caps relative to large caps. I'm not saying we're going to see that again, but I'm just saying they're cheap. They're growing. They're still not all that loved. We got an economy that's going to avoid a recession, in our opinion, and now you got the Fed cutting. Those are all our backstops or tailwinds for small caps to continue to do pretty well, along with mid caps as well. One more comment on this. Art hammered it. I talked about it also. But housing, I think, was detracted from GDP like 10 or 11 quarters in a row not that long ago. But now with interest rates coming lower, we think it's going to unlock. Look at, like, well, no pun intended, HELOCs, a lot of different loans. There's a lot of people have cash in their houses that just kind of sitting there. Now with things going lower, that could unlock a lot when it comes to the consumer to continue to help drive and grow this economy. So I'm behind Art 100% there. That's something I don't think a lot of people are talking about. Talk about surprises next year. I know we might talk about that. That could be a big surprise, is how much housing contributes to economic growth going forward. Because I still don't think a lot of people are expecting that.
Okay. Let me shift a little bit again, if I may. And I'll move into the political realm. And it feels like every year we have the same conversation with, what's going on in Congress and what's going on with the budget and et cetera. Any bets on the budget, and what are the chances that Congress will, start to function better?
Yeah, so we're in an election year, so unfortunately, no, nobody's going to start to function well unless and until we get that behind us. Again, and it is amazing that three things. First of all, we have to get a budget by the end of September, and or a continuing resolution, which is something that catches us by surprise as a country our size every year. But I think even more importantly, in a presidential election year, when you think about people that would actually like to promote a Trump trade or a Harris trade. And if you ever look back at any of these proposals that anyone makes, they were always abysmal, because the reality is, Roger, you can say anything you want when you're running for president, right, on the campaign trail. And then once they give you the keys to 1600 Pennsylvania Avenue, you open and you go to your office, you find out almost all of what you said is going to be near impossible to put into place, right? So the campaign promise versus the reality hits everybody, and you'll find out in real terms that got me elected, but I can't get it done. Just going back to 2016, here's a great example. So if I wanted to put a Trump trade on, he loves drill, baby, drill. He loves energy companies. He loves oil. He loves that whole industry. And he's not a big fan of wind and solar and alternative energy. If you made that bet, that Paris trade, and you shorted alternative energy and bought the energy complex, you got completely annihilated for reasons that had nothing to do with Donald Trump, but just how both of those sectors played out. You would actually put that trade on in reverse with Joe Biden, and the exact same thing again. You got absolutely upside down on that trade, because it's the market, it's the economy. It's not what the president happens to like or talks about a lot. It's just how things are driving in this economy. We're producing more energy as a country than we ever have. Alternative energy has come out of favor in the last 4 years. So it's kind of thinking about politics and your portfolio is a really, really big mistake. And I'll give you one last piece of the puzzle. So if you went back to 1953, Bank of America just put this out last couple of weeks, which is interesting. And you invested $1,000 in the called the S&P 500. You have $1.6 million if you left it in straight through reinvested dividends. If you just put it in either with just Democrats in the White House or just Republicans in the White House, that $1,000 now today would be something between $25,000 and $40,000, depending on what party it was that you invested in and how much time you had in the market. So to the extent of making a decision about your long-term investment plans and who happens to reside in the White House is probably one of the biggest mistakes that investors can make.
Well said there. I'll kind of chime in building on that. People always say, well, who's better for stocks, right? Democrats or Republicans? Now, I'm going to give an answer. If you don't like it, just wait. I'll give another answer. Technically, stocks have done a little bit better under Democrats throughout history. There have been more Democratic presidents over history, too. But when you have both chambers of Congress that are Republican, stocks do significantly better. But here's where we are with things. If an Art did laid it out perfectly, I would say, we stress this all the time, do not confuse your political beliefs from your investments, because so many people do that all the time. Say, if so-and-so wins, I'm getting out. If so-and-so wins, I'm doing this, doing that. If the economy is strong, that's what matters more. I think we've done a really good job saying why we both think the economy is in pretty darn good shape going forward. But here's what investors should wake up to, I guess, November 6th, right? November 5th is the election, November 6th, what they should be rooting for from an investment's point of view. A divided Congress. The last 13 years, we've had a divided Congress. Stock market's gone up. This is probably going to be the 14th. Why is that? Checks and balances, not too much power one way or the other. Big blue wave, big red wave. Markets might not like that very much. Of course, who's in the White House matters, not ignoring that at all. But for you, those checks and balances, not too much spending, wasteful spending, if you're in too much power, that's what I think really matters more for investors. And you think about right now, right? Where are we right now? 51-49, Democrats in the Senate, and the Republicans have, I think, a 4-seat majority now in the House, smallest in 140 years. I'm not the expert here, but a lot of smart people that I follow think that's going to flip-flop just by a little bit. So we're still probably going to have a divided Congress when all is said and done. And under that scenario, again, you're talking stocks up looking at 14 years in a row. Is it random? Yeah, maybe some of it is. There's probably other things that matter in there, but that's one of those things I would not ignore. So let's just see how it all shakes out. One other thing, October election year, already said this, is usually pretty volatile. Like October is the most volatile month on average. Yes. But November and December historically are quite strong. Market in an election year, markets can take good news. Markets can even take bad news. They just hate uncertainty, and we're going to have a good deal of that coming in. But if we still divided Congress, like we think will be the play, when all is said and done, that's still a positive, I think, for all the investors out there listening to today's discussion.
I think that's really, really helpful, and thank you. You both work for strong retail organizations. What type of questions are you both hearing from the financial consultants who are at the front lines and who are obviously talking to and helping mom and pops invest?
Yeah, that's such a great question. And you've asked some of them. I think that, typically, where you stand on things depends on where you sit. And by that, I mean, a lot of financial advisors will say, isn't, this terrible? And then, how do I think about that? So I spend most of my time kind of busting up myths, and we call that the myth busting part of the job. And some of that is to Ryan's point, the denominator blindness. And so when, it's easy to click on a story, Roger, that says, oh, credit card debt has never been this high. Well, we haven't had this many people. And if you don't put the denominator in and say, what is it as a percentage, then you can be, that scares me. So the three biggest questions I get is, what should we do about the election? And we kind of answered that. I think, you don't make big changes to your long-term diversified portfolio around an election season because it's the wrong thing to do. The second thing I think the most intriguing to me is what happens historically when interest rates start coming down? And you've asked some of those questions. What does that start to drive? And we've started to see some of that. So if you have been overweight technology and communication services, and it's not too late to sort of think about diversifying out to things like small cap, mid cap, and other parts of the S&P 500. So what I thought has been intriguing in the last month or so is that the equal weight S&P 500 has outperformed the market cap weight, and that's just another way of saying advanced decline lines and breadth and all the other things that are positive. But I think if you look at the preponderance of your investments, and a lot of it has been focused on the sort of exciting shiny objects that are the artificial intelligence darlings, and you are underweight some of the other sort of less exciting parts of the market, I think that's the important piece. I think the third thing is that the biggest question we get away from what do I do about the election and am I diversified? The third thing I think we get the most is what happens if, and we've touched upon this a little bit, and the biggest new if is what happens if China does something in Taiwan, right? So, and just got this at a conversation I had less than a month ago with a very large financial advisor who covered a very large union. And I said that the three ways to think about this is that the reason China hasn't done that yet, in my opinion, is that they saw the reaction to Russia on the global scale when they invaded Ukraine and were shocked. I think China looked at that and said, wow, the world really doesn't like things like this. Maybe it's not the time for us. I said the second thing to think about is China's in terrible shape, even with the recent stimulus that they've tried to apply. Demographics are terrible. Their amount of debt is terrible. They haven't been able to recover post the pandemic. They're trying to. This is not the time. I think China is going to say, you know what else we're going to do to destroy things and incinerate money is do something in Taiwan. The third thing, and this is going to sound heartless, but if China does something in Taiwan, your investment in NVIDIA or some technology stock is going to be the least of your problems because that's going to start something larger than we would envision. So That's sort of going from the mundane to the ultra scary, and that's kind of the spectrum of questions we get from advisors. And we tend to try to meet them in the middle and say, you know what, let's think about what probably is going to happen, not the worst things that we can imagine, and try to do that kind of hand holding.
That was awesome. I mean, I'll make this quick. I know we're getting near the end. We have almost 500 advisors in 42 states here at the Carson Group, and we get the same concerns and questions that Art just laid out there. But I think the one that I really like to focus on the most, we kind of hinted at this already, is the shiny object, right? This is the best sector. So my clients all want to get in it. And I work with a really smart guy named Sono Varghese, who's our VP global macro strategist. And we have that podcast. You talk about facts versus feelings. We're always trying to break the myths of what's going on out there and show what's really happening. I think it's just so important to remind the financial advisors out there, and they know this, and that's why financial advisors do such an amazing job with their clients, is to help their clients not always chase a shiny object. Maybe to consider investing in something that hasn't done so well for a couple of years, because maybe that's the time. I mean, literally the time we're recording this, like utilities are like the top group, right, for the year. I mean, but utilities did terrible. The last couple of years, interest rates are higher, different things going on. So who really wanted to own a bunch of utilities this time a year ago? I didn't. A lot of people didn't, right? But here we are. And that's why, again, keeping a diversified portfolio, rebalancing every 3 to 6 months, paying attention to the news, but ignoring the headlines from a purely investment point of view, because that's what you have to do to reach your long-term investment goals. I think it's such a special job that so many great financial advisors all around our country do every single day. And it's something that is really important to help families who really don't understand these long-term stats and numbers and things that we all take for granted to reach your long-term investment goals. And that's why it's so important what financial advisors do out there.
Very good. Well, as Ryan, as you noted, we are almost out of time. So I'll put one last question out for you both, which is as we are exiting 2024 and soon approaching 2025, what are the biggest risks in your eyes? And I'll also say, what are the biggest opportunities? And I think we've touched on some of them, but I'll give you a chance to kind of recap and move us forward.
Yeah, I would tell you that's a great question. We get it all the time. I don't know why we just always pin that to the calendar. That's when we have to put out our forecast for the next year and what our targets are for the S&P 500. But we should have that kind of in our mind every day. And for me, I would say the biggest risk that I continue to have is that China never comes back. Right? China isn't able to dig themselves out of a hole. I would give that on a scale of 1 to 10, like a 3 or a 4. But it's certainly been a long, drawn-out reopening process for their economy for a lot of structural reasons. But they're an important part of the demand for goods and services globally. I think they will find a way to recover. I would say that the biggest concern away from just that economic concern that I would have is that we have a long, drawn-out unknown around the election. And that continues to go to the Supreme Court, like the hanging chads and Bush v. Gore, and that causes a great deal of uncertainty that can cause an economic slowdown, and that whether that's exiting the year or entering next year. But that'll resolve itself. That's not a prediction, and this is well before the election. But for those of you that don't remember, that was causal of an economic slowdown for a period of time, and then things did very well. I would say the biggest surprise, we touched upon it earlier, is the economic activity that happens when interest rates come down. And one area of the economy that just hasn't had any activity forever is housing. And I think that's going to be the biggest surprise of 2025 is that existing home sales are going to explode. And when inventory comes on, that doesn't mean the house pricing has to go up. And there's a bid for that housing sitting right under the market right now with millennials that are just getting to that point where they need that house. So I think that's going to be the biggest upside surprise next year.
Yeah, you talk about surprises. It wasn't that long ago we were told 60-40 is dead because 60% stocks, 40% bonds, diversified portfolio. In 22, stock market in a bear market, bonds had their worst year since apparently George Washington was in president, according to our friends at Ned Davis Research. But what have we seen, right? We had that 8% violent pullback in early August, yet bonds are up 5%. Okay, so finally, a diversified portfolio, you're starting to get some juice out of your bonds. We think we're getting more back. I don't know if this is a surprise or not, but we're getting more back to normal. That should be how things are, right? Before 22, you look at all the year, I think 5 or 6 years had a bear market down at least 20%. Bonds are up like double digits every time. All right. I'm not saying it made up for everything. Lost 40% in the stocks in 2008, but bonds are up 10, 15%. Not saying it made up for everything, but it sure helped. So that's something I think investors really need to remember, because it wasn't long ago people said, I don't want to own bonds. I don't want to own bonds. Well, now with this Fed cutting and different things going on, a diversified portfolio makes a lot of sense. But my worries, we've touched on them. I agree. I'm with Art there. I mean, I think China, right? If China does something with Taiwan, that absolutely, we wouldn't even call it a black swan. Black swan, something you don't really see coming. But that is clearly the big thing that's out there. Don't expect them to do anything. And I'm also second with the election. Markets don't like uncertainty. If something happens to the election that goes on further, that's something that clearly could add some indecision and some more volatility. But I guess the bottom line for people out there listening to this is hopefully we've laid out here the last 45 minutes or so. This is still a bull market. There's a lot of opportunities out there. The economy still looks pretty darn strong. Probably not going to have a recession over the next 12 months, at least next 12 months or so. So just kind of remember that. Those headlines are going to be scary, but continue to focus on your long-term plans and listen to your financial advisor. And I'm just honored we got to do this one more time. So thank you for having me back.
Gentlemen, unfortunately, it looks like we're out of time. But first of all, I want to thank you so much, so very much for your participation today with the conference and for doing this video. I've certainly learned a lot, and more importantly, you keep reminding me of the things that I need to be focusing on as I look out into my investing horizon. So thank you. To our viewers out there, thank you for watching this video and participating in our Lytham Partners Fall 2024 conference. We hope you all enjoy the conference. Thank you again.
Thanks, guys.
Thank you.